Good afternoon, everyone. It's 72 degrees and mostly sunny outside, at least from my vantage point. And welcome to Perkins' latest webinar. We're going to get started in about 60 seconds. So if you want to grab a sandwich, put on your sunscreen if you happen to be out on your deck, we'll start in about 60 seconds. All right, everyone. Good afternoon. I am Dave Sullivan, the Director of Business Development and a shareholder at Perkins & Company. And we want to welcome you to our latest web Zoominar and what will be actually the first of a four-part series that we are putting together, established and developed by the Perkins real estate team of experts. And as the largest locally owned accounting firm in the state, we've been hosting in person, as most of you know, face-to-face meetings down in the lounge in our building for about the past 7 years. We call it the Real Estate Connection. So this is our first virtual event for this group, and we do in fact miss seeing all of you. So a couple housekeeping matters. Since we have a lot to cover in the next 30 minutes, we do have the Q&A function. You'll see it at the bottom of the screen. And if you have a question, all you need to do is click on that and please pose it for us. Due to time constraints, though, we will not be answering the questions during this 30-minute webinar. We will, however, compile them, put the answers together, and then send that out to all of the attendees within the next week or so. Also, the session is being recorded, so you'll have a chance to look at it again or share it with friends. And again, all of you who are attending are off camera and off mic, so you don't have to worry about that. So since our time is short right now, the first of this series, I am joined by two members of our extensive real estate team, which is the largest industry group at our firm. And they are Trent Bakel, who's a shareholder on the tax side, and Sam Waddell, who is a tax senior. And we are going to be discussing a number of the tax changes that have come about due to the CARES Act. So I pass the microphone to Sam.
Thank you, Dave. So as Dave alluded to, we've had some favorable tax law changes due to the CARES Act. And one of those changes was the fix to the retail glitch related to the qualified improvement property that all tax accountants were waiting for and knew was hopefully coming after the Tax Cuts and Jobs Act. So we got our fix. Now we're able to change QIP from 39-year depreciable life to a 15-year depreciable life and accelerate deductions via 100% bonus depreciation. But first, we need to know what qualified improvement property is. So let's move on and see. What is qualified improvement property, or QIP for short? So there's two requirements in order to qualify as QIP. The first one being that it has to be the non-residential real property, and that your improvements are made to the interior portion of an existing building and common area. So some examples we've included on the slides are the installation and replacement of non-structural walls and partitions, lobby renovations, ceilings, interior doors, fire protection systems, electrical systems, HVAC, and plumbing. And I'll point out here, you'll see that one of the requirements is not residential real property. So this will not apply to residential real property. You can't capitalize and depreciate them via the favorable life. It's, you know, the 27.5-year normal depreciation for any improvements made there. So this is just on the non-residential and commercial side.
I'm gonna put you on the spot, Sam. What about mixed use property?
I'm gonna kick that back to Trent.
All right. So mixed use property, it really depends on how the property is classified. So there's a bright line test for mixed use property where if 80% of the rents come from the residential side, then it's considered 80% or more, then it's considered residential. If it's less than 80%, then it's considered non-residential. So for mixed use property, we need to know what that split is of the rent. If it is more than 20% of rents coming from commercial space, then it would qualify for QIP for those projects.
Trent Bakel with the extra credit, everybody. So moving on, you'll note that there are some exclusions from the qualified improvement property treatment. So if your improvements are made and attributable to your internal structural framework of your building, those aren't going to qualify. If your improvements were made to the exterior portion of the building, those aren't going to qualify as QIP. If your improvements were made to enlarge your building, that's not going to qualify. And if your improvements were to the elevators or the escalators of your building, that's not going to qualify either. So if you've been in our building in the last year or so, minus the pandemic, you'll see that the PacWest Center underwent a pretty extensive lobby renovation, where the majority of that, if it, none of the improvements were to the internal framework of the building, they would qualify as QIP, except for them moving the escalator from, straight shot from the front door to now to the side door. That would not qualify, moving that thing. So now we know what qualified improvement property is, and let's see how we were supposed to be able to depreciate it under the Tax Cuts and Jobs Act. So QIP was originally intended to be 15-year property beginning in 2018, and it was, any class life under 20 years is eligible for bonus depreciation, which is 100% between tax years 2018 and 2022. But due to a drafting error in the Tax Cuts and Jobs Act, QIP was not explicitly included in the definition of 15-year property, meaning that we would have to depreciate it over 39 years, straight line, no bonus depreciation. So to the frustration of taxpayers everywhere and CPAs, Treasury and the IRS consistently held that they had no authority to correct these omissions and required a legislative fix or technical correction. Since the drafting error was in tax law itself, it was required a fix by the government. So how does our government fix things? Well, we have a worldwide pandemic. And we had the CARES Act pass in March 2020, which provided the technical correction to fix the drafting error. This included QIP in the definition of 15-year property via these two code sections, meaning that it would be eligible for bonus depreciation, which is again 100% between tax years 2018 and 2022. And the CARES Act allowed this fix to be made retroactively back to January 1st, 2018, so it would qualify for any improvements that you made in 2018 as well as 2019. And so the IRS provided us with guidelines to correct the treatment of QIP via the CARES Act, which are these two Rev Procs that you see on the slide. So let's continue and see what we can do to fix it if accelerated depreciation was not taken in previous years. So these slides kind of have a lot of options and scenarios and things, so I'm going to preface it and give you a couple of questions to ask yourself prior to performing any analysis on your improvements. So the first one being, when were your QIP additions and what returns have been filed? And then when would you like to take the deduction? So in this first case here, you've already filed your 2018 tax return that was due during 2019, should be done, barring anything crazy, but you have not filed your 2019 tax return. So you've got a couple options for if your QIP was placed in service in 2018, you can amend your 2018 tax return, or you can file a Form 3115 application for change in accounting method with your 2019 tax return. And if you had QIP placed in service in 2019, you can just treat it correctly as 15-year property, and it's bonus depreciation eligible, and take the 100% bonus depreciation on your 2019 tax return. So with the CARES Act, the IRS gave us the ability to amend 2018 partnership tax returns or file an administrative adjustment request, which is why you'll see, amend or the AAR on the slides. In most cases, amending the 2018 tax return would be more favorable than filing the AAR. So moving along here, if you filed your 2018 tax return last busy season, last extension season, and you already filed your 2019 tax return, but you filed it with an extension, to the extent you have qualified improvement property placed in service in 2018, you've got a third option after the previous two from the previous slide, so you can amend your 2018 tax return. You can file the Form 3115 change in accounting method with a superseded 2019 tax return, and superseding is now a simplified way to correct a tax return rather than having to amend or file the AAR. So that's a new option. or you could file your 3115 with your 2020 return. The IRS allows you to catch up 2 years on the 2020 tax return if need be. And then for qualified improvement property placed in service in 2019, you can again file the superseded 2019 tax return, and you, like the previous slide, just treat QIP as normal 15-year additions and take 100% bonus on those, or you can file a Form 3115 with your 2020 tax return. And then walking along to our third scenario, so you filed your 2018 tax return, you filed 2019, but you did not file an election prior to 3/15 to extend your partnership tax return. So this one's got a couple more options that are walking along the similar lines from the previous slide. So option 1 for qualified improvement property placed in service in 2018, you can amend that 2018 tax return, or you could file a 3115 with a 2019 amended return. And since you did not extend that return, you would file that amended return under late relief provisions within the 6-month period from when you filed, or from the original due date of that return, or you can kick it all to 2020 and file your 3115 then with that 2020 tax return. And for QIP placed in service in 2019, again, you could amend that 2019 tax return or wait until 2020 and catch up the depreciation then via the Form 3115. And all these scenarios that were just presented to you, the ability to take 100% bonus depreciation is dependent on if the election to be treated as a real property trade or business was not made. So that comes into play with the 163J interest expense limitations, and kind of, you know, the slide says that additional analysis should be done to determine how accelerating this depreciation will affect other provisions. And Trent's going to discuss that later in the presentation. If you previously made that election, how we can get out of it. So some of the big picture takeaway items from this QIP: which year did you have the improvements? Which year did you place them in service? Which tax returns did you file? You have to know that there are options to correct and address these additions if you previously didn't accelerate depreciation, and we can catch it up whether via amending or filing the 3115. It's all going to depend on when you want to take that deduction. So amending, you're going to take the deduction in the year that the qualified improvement property was placed in service, and the change of accounting method via the 3115 is going to be in the year that you're filing that tax return. So you're going to want to do some analysis to determine which year would be the most favorable for you. And none of these options are right in every scenario, and it's a lot of math, a lot of CPA work, but Trent's going to talk about, you know, what you can do if you're carrying forward or accelerating this depreciation where you previously couldn't. So take it away, Trent.
Yes, I'm going to add on more layers of math and CPA work and options. You know, there was, you know, thanks, Sam. That was a really good overview. That, you know, is really nice that we got some as part of the, you know, it's just taking a quick step back. The CARES Act got a lot of publicity for the PPP, the Paycheck Protection Loan, and the stimulus checks, which were, you know, all the highlights of the economic highlights of the package. But there were some tax provisions in there, including QIP, and I'm going to talk about some loss provisions as well that are going to be very beneficial, especially in the real estate side of things. You know, I know personally I wasn't all that hopeful. I think you used that word, hopeful, that we were going to get the fix. I wasn't all that hopeful. You know, I think that there's a lot of people that would have traded off wearing a mask a little bit to get these deductions earlier. But the good news from what you had talked about, Sam, was, you know, there's not just one way to fix it. We've got some options, so we can look at kind of two sides of it. We can look at what's going to be the best tax answer, which is clearly going to be the most important part of it. But then we can also, if there's not that much of a difference in the tax answer, is there one way that's going to be a little bit easier administratively, rather than, you know, for example, going back and amending 2018 and opening up, having to amend a bunch of individual returns, things like that. So starting to talk a little bit more about the analysis that we may be needing to look at is on the loss side of things. So again, as part of the Tax Cuts and Jobs Act, there were some changes in loss provisions. So for our net operating losses, the change there was they removed the ability to carry NOLs back 2 years to get refunds of taxes. The CARES Act reinstituted that temporarily for years 2018, 19, and 20. And it also provided the ability to carry back 5 years. So, and this is similar to what happened in the last recession. Was they opened up the ability coming out in 08, 09. They opened up the ability to carry back NOLs 5 years to help taxpayers get access to their cash. This is really important now because, buried in here is the fact that as part of Tax Cuts and Jobs Act, tax rates changed as well. So, we've got a real opportunity in a lot of situations, especially if there were a lot of QIP placed in service it's going to be a big change going from 39 years to not just 15 years, but 100% because of bonus depreciation. The other loss change that was part of the CARES Act was a new provision, which was the excess business loss provision. So this is brand new in 2018. That was the first year we had to deal with it, where we're only able to take $500,000 of business losses against other types of income for married taxpayers, $250,000 for single. It removed this for 2018, 19, and 20. So the way that new rule works is we were limited there. Whatever we had of losses in excess would carry forward into the next year and would be allowable against income as a net operating loss. Well, this is gone. So if we had this in 2018, it's important to know that because this is a mandatory elimination or removal of this provision. And so if you had that, an amended return may be needed in order to claim the benefit of tax to get some additional tax back for 18, but then also if you already had an NOL that you're carrying back, you're going to need to amend to add that to that NOL. And so this is just a graphical chart showing what our options are in terms of the years. So the 2017 year, that was the old rules where we carried it back an NOL back 2 years to get taxes back. And so we can see for 2018 NOLs, we've got the ability to go all the way back to 2013. And so there's going to need to be some thought put into, if you're in a situation where you had QIP in 2018, is it going to create an NOL in 18 versus 19 or not? If we amend or is it going to create an NOL in 2019 because maybe we had some in 18 and 19 and we get the catch up in 19? If we have an NOL in 2019, we see here we take it back to 2014. It might not always be, I talked about there being higher tax rates in those earlier years, but it might not be worth it to carry it back because in those earlier years, did we have high taxable income or were we at lower rates than what we're expecting to be in going forward? Did we have some big capital gains that, even though we had a lot of income, drove down our effective rate and we'd really get more benefit of carrying it forward? That's where Sam's point is extremely valid. There's no one size fits all, that there's not going to be one answer for every taxpayer, and so there's going to need to be some analysis to figure out what's going to be most beneficial. But it's nice to have options, and there's real opportunity here to take advantage of this. The other significant change that came out of the CARES Act for real estate, this didn't impact every real estate client, but it impacted a number, was changes to the new interest expense limitation provisions. So, without trying to get too much into the weeds here, it's a very, I would say an overly complex area of tax reform. In a nutshell, what it does is it limits certain taxpayers, either large taxpayers that are over 25 million, 26 million now of gross receipts, or those that are considered tax shelters. It limits the amount of interest expense that can be claimed in any year to 30% of adjusted taxable income. And so the adjusted taxable income number is essentially taxable income with an add back for interest, depreciation, and amortization. At least that's what the calculation is for the next 3 years. Once we get into 2022, we no longer get the add back for depreciation and amortization. So that's what it is in a nutshell, just as a quick refresher on it. So what are our changes as part of the CARES Act? So for 2019, the major change is going to be for corporations or individuals that are subject. So if you're in that situation, you get the benefit on your 2019 return that you're now looking at 50% of that adjusted taxable income number. If you're subject to this via an investment or in partnership interest, essentially the partnership is the one that is limited, then you're not going to see any differences on your 2019 K1. So you're still going to be limited to 30%. You're still, if you are limited, you're still going to have that amount as a separately stated item of how much interest was limited for your share. Where you get the benefit is going to be looking forward to 2020 and the 2020 tax year. So there's 3 benefits for this 2020 tax year that are going to be available for partnerships. So the first 2 are available for everyone, which is another year with the limitation being increased to 50%. So individuals and corporations get that for both years. The individuals and corporations also get the second bullet point here, the second benefit, which also applies to partnerships, which is you can use 2019 adjusted taxable income for purposes of the calculation. And so why is that important? Well, I think the expectation as a general rule is that for most real estate companies and most companies in general, to be honest, is taxable income is going to be down in 2020 versus 2019. There's just, some pretty significant disruption that COVID has caused. And so we're expecting taxable income to be down. If we were using this 50% on the current year taxable income, then the benefit, there still could be some benefit, but it's going to be limited. We get to use that higher 2019 taxable income number with adjusted taxable income number. So hopefully, this will provide a nice benefit. I'm going to go through a very quick example here in a moment that'll show a little bit of the power of these changes. And then the third benefit for partnerships, here's where they get a benefit for tax year 2019, in that the amount that was allocated on their Schedule K1 in 2019, again, it was limited to the 30%. There's nothing we can do on this return. Automatically, we get to take 50% as a deduction. So we don't even have to do any analysis beyond that. We get 50%. The other 50% is going to be subject to our normal limitation. And coming out of a partnership with that limitation is we can only utilize that to the extent that we have excess taxable, excess business income for purposes of this calculation from that entity. So we may not be able to get the benefit of it in 2020, but we're accelerating a good chunk of that limitation from 2019 into 2020. As Sam mentioned, there's one-time relief available. So, for those of us that you've heard talk about this specific topic, this interest expense limitation, there actually is a carve-out where real estate companies can elect out of this. It came at a cost, and the cost being for real estate businesses to utilize this, they have to use an alternative depreciation system. And as part of that alternative depreciation system, it lengthens the life of assets, and it would eliminate the ability to get the 15-year treatment on QIP. So I know as a general rule, we were generally saying, don't elect out. We want to see what happens with QIP, and that election was an irrevocable election. And so we didn't want to make an election that was going to come back to bite us later. Well, luckily, the IRS recognized this, or the government recognized this, and they gave us a one-time get out of jail free card for anyone that may have made that election on their 2018 or 2019 return that's already been filed. So you do have a get out of jail free card. You can opt back out of these limitations and still get bonus. Now, is that going to be a better answer? It's going to be dependent upon your facts and circumstances. So it's not going to be, again, another one size fits all, but it is nice to have that additional layer of flexibility as part of this. So just a very quick example here in the couple of minutes that we have left, just in how it's going to impact a partnership. So here in this example, we've got, you know, kind of two columns, what we would have expected before CARES was passed and after CARES was passed. So in 2019, we're limited. We're only able to deduct $30,000 of our $60,000 of interest expense in our partnership. So we $30,000 of that is carrying forward. We fast forward to 2020, adjusted taxable income's lower. Our interest expense is the same. And so before CARES was passed, we were expecting to only be able to expense 12 of that $60,000 and have to carry another 48,000 forward. Well, after CARES, not only are we limited, not only was that 30% limitation increased to 50%, we're also able to use that $100,000 of 2019 adjusted taxable income. So now we're only limited $10,000 and we're able to deduct 50. So that's a $38,000 increase in our deduction for 2020. Then we layer on the fact that we were able to deduct half of our prior year limitation of 15,000 right off the bat. And so in, you know, in this very simple example, our benefit is going to be over $50,000 of increased deductions in 2020. So, you know, kind of wrap all that up to say, you know, there's a lot of moving pieces here for a lot of real estate businesses between QIP and additional interest expense that they may be getting in either 2019 or 2020. And so we really want to take a strong look at, you know, what is this going to mean for you in each of these 3 years, depending on your fact pattern, on whether you had QIP placed in service in 1, 2, or all 3 of those years, what your interest limitation may have been in 2019, to really make a good decision for you on whether it's better to amend, whether it's better to carry back NOLs and get tax refunds for earlier years, or whether it's going to be better to just carry those losses forward when we get back on the other side of this and get back into you know, higher levels of taxable income. You know, it's you know, there's like I said, a lot of variables, a lot of moving pieces in there, but that offers a lot of options and a lot of opportunities for us during this time. So with that, I'm going to kick it back to Dave.
Thank you, Trent. If anything, we are timely. We have about 2 minutes left, and I guess the takeaway message is not to go it alone, and make sure that you're seeking the right advice specific to your business. Correct?
Yeah, absolutely, absolutely. And you know, it's you know, now more than ever, you know, I know it's really tough to look at projections for 2020 and beyond when we're in the middle of it. You know, hopefully this is going to offer some relief for cash flow purposes, whether it's planning for estimated taxes this year or the ability to carry some additional deductions back and get some more money back in our pockets.
Excellent. Okay. Well, we want to thank everybody for joining us, and especially thanks to Trent and Sam for the expertise that you guys brought. And we hope this was a valuable session for everybody. And reminder that any questions that were posed, we will be answering them along with providing the recorded video sometime next week. But again, we urge you to reach out. If you're a Perkins client, please reach out to us if you have any specific questions, and we know we'd love to help you there. Also, we hope you register for the next of the series. So this is the first of 4 parts. So our next session is going to be July 23rd at noon. Each of these is at noon, 30 minutes each. We're trying to bring you some short snippets and valuable information. So the next one on July 23rd is covering estate planning ideas during the pandemic and also in advance of the election. August 6th, also at noon, we're going to be covering the Oregon commercial activity tax and other taxes related to the real estate industry. And then August 20th, also at noon, we'll focus on debt workouts and tax implications. So again, we thank you all for joining us. Hope this was valuable. Be well and strong, and we look forward to seeing all of you face to face very soon. Take care and bye-bye.